Hey guys, what's up? Welcome back to the web. So, we all been hearing news about inflation. See, a lot of persons don't understand that inflation can actually affect the prices of items or products that you purchase on a daily basis because there's too much money in circulation. So, it's chasing too few goods. So there's too much money chasing goods. So therefore the cost goes up for each item. But I'm not going to get into economics today. What I'm going to get in is Market Watch and their opinion piece. So the markets are very important because they reflect the state of the economy. To break it down simply, so I'm going to read this article because it's very interesting. It's my first time reading it, so bear with me. I'm definitely going to be as honest and raw as possible. This is the nature of the web. We try to be transparent and clear and unbiased as possible with our information. Guys, if you really like this content, please like and subscribe. And if it'll really help me out and the YouTube channel a lot. So let's get right into it. So it's an opinion piece from Market Watch, and it says inflation is rising and so are investors' fears about stocks. Stocks actually are an inflation hedge, but the market doesn't see it that way. Here we have this lady right here. Nice photo. Inflation. Let me start over. If inflation is a threat to the stock market, we should be running scared. That's because inflation expectations have spiked dramatically in recent weeks. The 10-year break-even inflation rate, what the bond market currently is betting inflation will average over the next decade, is now higher than it's been in 5 years. As you can see from the accompanying chart, expected 10-year inflation stood at just 0.5% last March. This past week, it's going as high as 2.24%, highest in over 5 years. Alright, so here's a chart. And break it down as simply as possible. Here you have the percentage yield and the years. And this is inflation going close to 2.5%. It's right here, currently a little bit above 2 in 2021. This was 2020 figures. So it says that the difference in yields between a 10-year treasury note and 10 years TIPS. The source is the Federal Reserve Bank of St. Louis. In truth, inflation is not the threat to the stock market that most investors believe. If inflation continues to heat up in coming months and investors react by dumping stocks, you might want to consider it as a buying opportunity. Hear that? It's a buying opportunity. Yeah, because its stocks are obviously cheaper, right? I'm not a financial advisor, guys, but yeah, don't take my word for it. I can't tell you what to do, but common sense tells you when people dump their stocks, it goes lower. That is a good indication to actually buy because it's cheaper, but it's not curtailed to your specific situation. You have to do your own research. With that said, let's continue. These are the conclusions I reached after interviewing Richard Warr, a finance professor at North Carolina State University. Warr co-authored a seminal 2002 study in a Journal of Financial and Quantitative Analysis, which found that equities actually are a good long-term hedge against inflation. His co-author was University of Florida finance professor Jay Ritter. Warr explained that stocks are a hedge because inflation impacts equity valuations in two ways, which largely offset each other. High inflation means that future nominal earnings must be discounted at a higher rate when calculating their present value. Corporations are able to charge more when inflation is higher. Because of this greater pricing power, their nominal earnings in future years will be higher than they would have been otherwise. Notice the small net effect of these two factors. Nominal earnings will be higher but must be more heavily discounted. This isn't just theory. By the way, over the last 150 years, real, that is inflation adjusted growth rates for the S&P 500's SPX was negative 0.19%. Earnings per share have remained relatively stable in the wake of changes in the inflation rate, while nominal EPS growth rates have tended to rise and fall in line with these changes. Investors typically focus on just the first of these two consequences of inflation, Warr said. That is, they at least implicitly realize that inflation reduces the value of future nominal earnings, but overlook that those nominal earnings will themselves be higher. This lopsided view is due to a trait that economics call inflation illusion. Interesting. This illusion works to be the benefit of stocks when inflation is declining. When that is the case, investors extrapolate into the future the artificially high nominal earnings growth of earlier higher inflated periods. The result is unreasonably high valuations. When inflation begins to rise, in contrast, investors make just the opposite mistake. They extrapolate into the future the lower earnings growth firms produced during the previously low inflation period. This leads to them to conclude that equity valuations must come down as inflation heats up. Rational versus behavioral modes of investors' behavior. Notice that two distinct models of investor behavior are needed to explain the market's reaction to higher inflation. The rational mode shows that inflation should have little net impact on equity valuation, while the behavioral mode predicts that investors will nevertheless behave irrationally. Might investors have learned from their past irrationality and therefore not dump stocks if inflation heats up even more in coming months? Warr said that while anything is possible, he wouldn't bet on it. Most current investors have lived most of their lives in a low inflation environment, so they have had no opportunity to learn the lessons that history teaches us about inflation and the stock market. If Warr is right, then rational investors in coming months will have an opportunity to pick up stocks at lower valuation. Alright, so the article is a lot to digest. So basically what it is saying is that when inflation hits at a certain peak, that investors make irrational investments by dumping their stocks, which they shouldn't be doing, because the stocks are actually going to be cheaper, like what I said. And as the economy stabilizes, when the economy stabilizes, the inflation rate will go down. So this is actually good for companies, kind of bad for consumers, but when you're investors, you're thinking about the bottom line of the company. So prices go up, therefore they make more profits. It might have a little bit of a less value, but in the long run, if the economy is stabilized, then everything should mesh and work and be better as everything gets back to normal inflation rate. Thank you guys. Please like and subscribe, and welcome to the web. Hope y'all enjoys this article.